Good afternoon, ladies and gentlemen. Let's say we have a session on communication signals to financial markets. We have two fascinating talks, and very interesting that both speakers are from European Union, still European Union. And let's say the first talk is by Carlo Altavilla, and it's about measuring euro area monetary policy. I'm lucky, and yesterday Zena introduced that fascinating database, and today Carlo, will give us more insights.
Thanks for having me and the paper, including the program. It's a great pleasure to be here, and I hope I'll actually catch up with your words and give some fascinating chart or illustrate what we did in the paper. So that's a paper with Luca Brignolini, Refetto Cainac, Roberto Motto, and Giuseppe Raguso. Giuseppe is here in the audience, so he can chip in if he thinks I'm not responding well to questions. And of course, I work at the European Central Bank, so whatever I say, it's me, and do not reflect in any way the opinion of the ECB or the Euro system. So, why we have this paper? Where we look at the chart on your left-hand side here, you see that until 2008, of course, these are the three main interest rate of the ECB. So the marginal, the main refinancing operation rate, the rate on marginal lending facility and the rate on deposit facility. You see that more or less the monetary policy was conducted by changing interest rate until 2008. On the right-hand side, you see the reflection of this into the neutral liquidity allotment of the balance sheet of the bank. Since then, of course, we have restored as many central banks to non-standard measure, and this has impact a lot on the balance sheet, but also you might see, for example, now the balance sheet, the excess liquidity is about 2 trillion, and taking out all these risk from the end of the private sector might have influence that goes beyond looking only at the single short-term rate. So what I mean by that, I mean that actually when you want to find the monetary policy stance nowadays, you don't have to look anymore at the very short end like before the crisis, but you have to look at the entire term structure. And this is the multi-facet way of looking at the monetary policy stance that we use in this paper. So we want to see whether particular policy communication affects the entire term structure. So we're not limiting ourselves only to the short-term segment of the term structure. Why? Because you see, for example, on the left-hand side here, that moving from the solid blue line to the solid red line, you see that these are typical movements, for example, entailed in a QE announcement whereby extracting duration risk from the end of the private sector leads to a decrease in term premium that affect mostly the long end of the term structure while maintaining the short term actually basically unaffected. So you want to see how to, our idea was to see how we can map each communication from the central bank into a particular yield curve configuration, and what are the what kind of particular communication or measures affect the different segments, if anything, of the term structure. Then we thought, okay, but once we have these, then we can even go beyond and check whether this particular policy affect differently a number of assets. And we look at the sovereign bond, the stock market, exchange rate. And then we would like to, of course, we said, okay, but let's now generalize this methodology, if anything, if we can look also outside the official policy communication, for example, a board member that gives a speech or a Bloomberg news that goes into the market, how we can actually translate this into our methodology to frame the effect on the term structure. And this is what motivates us. The precondition to react, to respond to all these questions is to build up a high-frequency database. This is what we did. So an high-frequency database for different assets. You will see there are 45 assets that we include in the database. And because we spend so much time in constructing and building this, we make the decision to make this publicly available, so you can, I will show later where to find the data set. But that's what we do in the paper. So we create and present what we call the Euro Area Monetary Policy database, which is, again, available on the ECB website. We try to map, again, policy event, official policy communication into yield curve configuration. And by doing that, we estimate, rather than assume, the policy factors behind this reaction. I'll be more precise in a minute. We measure the impact of monetary policy on a certain number of assets, and we generalize the factor extraction methodology to other non-policy or policy-related but non-official policy communication. So that's the outline. This is admittedly too long. I will be selective also in the interest of time. So I'll first say something on the Euro Area Monetary Policy Database, then I'll look at how to measure monetary policy action over the term structure. I'll say something on the asset price response, concentrating mostly on sovereign bond and maybe on stock market, given that many papers in this conference have looked into that. And then additional evidence, I will focus mainly on how to generalize our methodology to other policy events, and then I conclude. Okay, that's the data set. Before entering the data set, let me briefly, for those of you who are not familiar, hopefully many of you are familiar, I'll give you a little overview of how the information at the date of the Governing Council enter into the general public information set. So at the 1:45, at the Governing Council date, there is a press release. This press release takes this form here. So you will get something on the ECB website that says that the Governing Council has decided to 1, 2, 3, and these are the three main key ECB policy rates. So for example, this is the statement, the press release of the 4th of September 14, where we decreased by 10 basis points the three rates. So going, for example, the setting, for example, the deposit facility rate at minus 20 basis points. So, and that's it. So for most of the sample, this is the only information you get at the 1:45. So after 2015, you get something else also in this press release, but most of the sample is populated by this only information you get. And then we basically use event study methodology to build up an event window before and after this decision, and to look at the price changes of number of assets before and after. Instead of actually looking at the single minutes that might be not representative of the change, we got at the median. For example, in the median between 1325 to 1335, that's the pre-release window, and the post-release window is goes from 2 o'clock to 2:15. So that's what happened for rates. And this is, you might see, is very different from what happened with the Fed. So we have this way of actually identifying what happens for the rates to what happens for the actually what are normally called the introductory statement or the press conference. So at 2:30, and each day of the Governing Council, so some time later after the press release, the president, actually with vice president, goes into the room and first reads out the introductory statement. This is like a 15 minutes thing. And after, there is a question and answer session. And here, and this is much longer than before, right? So this is like the statement that contains, for example, that's a statement when we announced the APP, the Extended Asset Purchase Program. So you see it's very long. It's very difficult to read. It's very, I mean, you need a lot of specialized training, I guess, to read it. So it's not meant to be, I guess, for the very general public, but do affect a lot the financial market. And here, again, before and after, you can build up the event window. So that's the whole window of changes in the asset, whereby we can calculate the change due to the monetary policy event. so divided in two, and actually this would be always the two different event window. We look into that, and then we can have a third one where we actually combine the two, and we look at the overall effect of monetary policy. So what we do, we use the tick data to build up this event study database. We separate press conference and press release. We look at the price and return changes of a number of assets. Again, there are 45, I'll be clear in a moment. And it took us a lot of time to carefully clean the data for misquote or other kind of strange numbers that you might get in the Reuters tick data set. Again, we'll keep updated, so with some lag delay, some delay, but hopefully this will increase also the attention for the research on this area, on the European euro area, monetary policy. So these are the 45 assets. So we have overnight index swap, which for the euro area is the risk-free rate curve for different maturity, going from 1 month, 3 months, 6 months, 1 to 10 year, 15 and 20 year. Sovereign bond yields for the 4 largest euro area country at different maturity. The stock market index, you got a stock market, general stock market index, but also a restricted stock market index for banks. That's the ISX7E. That's the mnemonic in Reuters. And then 3 exchange rate, euro dollar, euro pound, and euro yen. And this is where you can find the paper. Actually, you go in the working paper, and here, after our, there's our working paper, and you see here, you can download, and that's an Excel file. It's easy to download. And that's the form that you get. So you get, for each asset, you get each policy date, and this comes into 4 Excel sheets. The first, it's notes, so it gives you, actually it explains you what is, for example, OIS SW. The second is all the surprises into the press release window. The second, all the surprises in the press conference window. And the third one is jointly considering both windows together. And these are the typical events that you might find, that you don't have to find because we find it for you, actually. So the typical events that we went to. So there are events all over populated, all over since 99 to today that moves actually asset. This is the OIS 2-year maturity that move the asset in the press conference only. So you might have, for example, this was when we introduced the forward guidance, moved only the press conference, the return only in the press conference. This is when, for example, again, this is the statement before, when we reduced by 10 basis points the interest rates, and you might think that this affected only the press release window. So you see that you have movement here in the press release window, but nothing happened in the other window. So these are an example of, instead of something that happened in both windows, or an example of a governing council that do not generate any surprise in the market, just was flat, no movement. So we get all this kind of movement, and it's assembled in this data set. So given that, what we do? So we want to actually use this data set to identify orthogonal changes to policy stance. This is how we find the effect of monetary policy. You have 2 ways normally, or either you require orthogonality with respect to the state of the economy. These are the VAR shocks, or orthogonality with respect to the market participant, and these are the market-based policy surprises, and these are the ones we are focusing in here. And if you want the identifying assumption behind all the paper, many of the paper in this conference, I just spell out here, is that by looking at the very small window around the policy announcement, we are sure that monetary policy does not respond to asset prices changes. Therefore, the causality goes from monetary policy to asset prices. So that's the identifying assumption basically behind all papers in the event study. And these are a selected number of studies that have used this concept. Many are in this room, so I don't have to be actually long on that. So methodology, this is also well established. This follows Refat previous work and also some recent work by Swanson. These are two-step methodology. You first estimate the latent factor behind so summarized in the surprise changes, and then you rotate factors to give some interpretation and to achieve some identification, okay? So you have a matrix Xj, where J is a press conference or press release. And as the data set that I just showed, this matrix, which is taken from the Eurasia monetary policy database, has changes in yield in the column and each row as an asset. And then this has a factor structure like X equal to Fj lambda J plus an idiosyncratic variation of yields at different maturity, where F are the common factor, latent factor, and lambda the factor loading. So the first things we do, instead of assuming how many factors are active in each policy window, we estimate first the number of factors and then we estimate the factors themselves. So when we estimate the number, when we test for the number of factors, we find that in the press release window, so mainly when there is a rate decision, there is only one factor active. And this is true either if you look into the pre-QE sample or in the full sample. When you look at the conference window instead, we find two factors if we restrict ourselves only to the pre-QE sample, and three factors if we instead take the full sample. So this basically suggests us that there is a third factor, namely a QE factor active in the conference window, and also this will be more clear in a moment. So how we build up the factor? So factors are invariant, of course, to orthogonal rotation, so we achieve identification, and again also to enhance some economic interpretation, we want to identify the factor as follows. So the first factor is one that is orthogonal to the first 1 month OIS. This is Gurkanak, Sackens, Wonson 2005. Second factor is orthogonal to the first, and the two explain most of the variation, again GSS. And the third factor, as in Swanson actually, 2017, is a factor that is orthogonal to the first and second and explains the minimal part of the variance of the pre-crisis variation, so the pre-QE variation, okay? And again, these are normalization that does not affect in any way the statistical result, which actually are invariant to all these rotations. Okay, how we name this? So the factor in the press release, the only factor we get in the press release, we call target factor, and the three factor in the conference, we call them timing, forward guidance, and QE. And I'll show you why. So these are estimates again. So nothing here is imposed, but the normalization or the scale that you might see. For example, in this case, we scale as such that this factor is a value of 1 at 1 month. And that's the shape that you get over the entire structure. So this is a factor, is a rate in the rate decision window that says that it maximizes the impact at the very short end of the curve, but being actually almost zero when you go to the 10-year, right? So when you look at the press conference, you get the timing. I'll come back here in a moment. You got this is a normal forward guidance factor that maximizes the impact actually at around 2 years, and then it goes down. So it's a natural M-shaped factor. And then a QE factor that instead have a maximum impact at very long maturity. And that's a timing factor. That is something that is similar to what Michael before was saying in some statement. In some statement, you get that policymakers kind of hint to some movement in the policy in the next meeting or the meeting after. So it reaches out the maximum at the 6 months or 1 year, but then evolves as a forward guidance pattern. And we have a lot of instances here where actually the policymakers explicitly say that they are confident, for example, they are comfortable to act in the next meeting. And then you get some movement as in the timing factor. So that's the result of, well, the statistical table that reflects the chart, but I am not going into that. It's just to say that all what I'm showing here is being estimated, not assumed. And that's the relative contribution of the factor. You see that the target factor is explain actually the 97% of the variation of the 1 month, the timing, the 87% of the 3 months, the forward guidance, the 2-year 70% almost, and the QE almost 54% of the 10-year. So these are where this factor are active in explaining the variation of the policy surprises. Okay, let me go now into the movement. So what do we do now once we have this? What do we do? So first we can actually check what happens to sovereign bond if you want to see the reaction of sovereign bond to monetary policy surprise in the different window. So this is the press release window, press conference window. This is the factor, and this is the 3 factors. You see, if we concentrate here on the last subsample, going from 14 to 18, where also the QE factor is active, you see that normally you have a lot of power in the target to explain the short end of the sovereign yield curve, a lot of power of the forward guidance to explain the medium-term maturities, and a lot of power of the QE factor in explaining the long-term maturity, the 10-year. And this is more or less similar to what you observed into the risk-free rate. It's just that the effects are higher, as larger, and thereby we can say that actually, where, for example, for QE, we understand this as QE narrowing the spreads vis-a-vis the risk-free rates. The same, this was for Italy, the same is for Spain. So you always get that for countries, so for individual countries, when you look at the effect of this policy of the QE in particular over the sovereign bond of Italy and Spain, you get that effect are maximized, for example, at the very long end of the curve, with narrowing the spread being a peculiarity of this kind of measure. So let me go now briefly into the stock prices, as this was actually present in many papers. Our evidence on stock prices is the following. So we get, when we get, so the first 4 columns here are for the broad index of stock prices. The last 4 are for the, only for the bank stock prices. So what we get is that actually the response are significant and negative for the target factor in the full sample. This means actually that the increase in interest rate are followed by a decrease in stock prices, so what you would expect. And also for the timing and forward guidance in the post-2014 sample. So we get some results that are not, so we miss some stars here to be happy actually. And we were wondering why we are missing these stars. And then we start thinking that the possibility could be to restore to some previous work. And this previous work, where we didn't have to go too far, because in the bank there is the work of Marek, for example, the work of Jeff with the co-authors, the work of Philippe Andrade, and the work of Giovanni here. So these are all works, all recent papers that actually says that in one way or another, monetary policy decision might be interpreted by market in 2 different ways. The first is a textbook, pure, if you want, monetary policy shock, or as an information, as a revelation of information about the state of the economy. And this is actually what, for example, it's the pure monetary policy shock and the information shock that Marek showed yesterday. We used also, instead of only looking at the stock prices and interest rate covariance correlation, we use also the expectation of inflation, and these are the inflation linked swaps. So the idea is always to use the cross-asset movement to identify whether you are in an Odyssean world, actually, or in a textbook monetary policy shock, or in a Delphic or information shock. So for us, these are all the same. And in fact, you can do this very simply with our model. So you look at you have the surprises. These surprises, this factor might be actually your instrument in an otherwise standard VAR with instrumental variable. You got the instrument Z that should be, as you know, these are the two identifying restrictions for VAR with this proxy VAR. This is a VAR which we call a financial VAR as a 4 variable, 2 years OIS. There's an exchange rate, a stock market price, and an inflation expectation rates is 2-year inflation linked swap actually, and these are the results that you get when you run this model. What you see is that the correlation between, so this is like after a shock in the target, in the timing, in the forward guidance, and the QE shock, and the QE factor. You see that the correlation across this asset changes when you go from actually the periods of 2008, 2014, so right after the crisis, to instead after 2014, where coincide with the period where the European Central Bank entered most forcefully into the market of a non-standard measure with many more measures that you see already still today. What you see that actually the periods in green, between the crisis and before the central bank started to forcefully act, is characterized as what we can actually see as a more Delphic behavior, while after the introduction of the targeted long-term refinancing operation, liquidity provision measure, negative interest rate, QE, then it reestablished, if you want, the fact that when you decrease the interest rate, this embody some positive like shock to the economy, whereby the private agent react by increasing their inflation expectation and stock market increase also. So that's the correlation in the 4 variable that that looks at that. So this is in a way actually reassuring in a way, because we find the exact same result of Marek and Karadi, but refining a bit the instrument to account for other cross-asset restrictions. Okay, let me just go into the composition of market reaction to other policy events, because we don't have other time. So how you do this in our framework, so you get a speech from your governor and you want to measure the impact, or how to, what kind of reaction you have on the yield curve. So what you do is to find first, select and choose an event window. You collect the yields in this OIS here, vector. And then, given the rotative factor that you have already estimated from the Euro area monetary policy database, you can find a factor that minimizes the sum square of residual in this formula here, which actually is simply an OLS estimator of the factor in the regression of OIS, meaning the data that change over the speech into the space spanned by the factor loadings. And these are 2 examples of, this was a speech by President Draghi and the Market News. We looked at the market reaction across these 2 events, whether this is a consistent story, actually. So we applied our methodology to these 2 possibly events. And what we find here is, in fact, that both events are loading more into the QE factor. These were 2 events where both the president and the market perceived the speech and the market news as actually hinting at the unwinding of of the ECB monetary policy accommodation. So it's in line with what actually we found in the QE. Okay, let me conclude because I'm out of time. I guess what is important here is that we approach this study as actually giving a public good, so making available a data set. Also, the codes will be available soon. We are just finalizing the README file. So everything is available online, so you can use it, and we will keep updated on the ECB webpage. So I guess this is a good opportunity and will actually decrease the time that researchers have to spend to analyze this kind of high-frequency movement, which is till today still the industry standard to measure the monetary policy shocks and the effect of monetary policy transmission on the real economy. But thanks, I'll stop here.
Thank you very much, Carlo. And now discussing is Jonathan Wright.
Okay, so thank you very much for inviting me to discuss this paper. I have the same enthusiasm for this kind of topic as my 7-year-old son has for his train set. So I'm very, very happy to be talking about it. So what this paper does is to construct and then analyze a data set of euro area monetary policy events. So it's looking at the jumps in asset prices, especially fixed income prices, right around monetary policy announcements. And of course, the surprises are multidimensional. So the paper does a very clever job of extracting some factors which have obvious interpretations. And to do that, it exploits the particular timing structure where you first of all get a statement and then sometime later have a press conference which is more detailed. And so in the end, it splits out a target surprise, 2 different forward guidance surprises, a sort of short term and a medium term, and then QE surprises. So it's a very careful analysis. And to show how careful it is, one of the things they pay attention to is governing council meetings are on Thursdays. And Thursday at 2:30 in Frankfurt is 8:30 in the US. And there are US monetary policy announcements, jobless claims that come out at exactly that time. So they're careful to control for that. So they've done a very detailed job. And they have a number of findings from this analysis. One is that QE shocks seem to be more persistent than some people have found in the US, that stock market responses depend on whether it's Delphic or Odyssean, and there's no evidence of asymmetry in the euro area, whereas there is some evidence for that in the US. But there's, at the same time, none of these findings here speak to the unique structure of the ECB. So you don't see in any of these findings evidence of the fact that the ECB is a currency union without a fiscal union, which I think is the special feature of the ECB. That doesn't show up in the monetary policy reactions. So that's a thing I want to talk about a little bit, and I want to show some pictures of yield changes. So I prepared my slides just before the database was made public. And so as a result of that, I'm actually using data from a much smaller scale, older data set that I constructed with John Rogers and Chiara Scotti. But I imagine that the results are going to be very similar. So this is a scatter plot from 2007 to 2010 in announcement window 2-hour changes in Italian and German 10-year yields around ECB monetary policy decisions, both governing council meetings and a few other announcements. And a 45-degree line is shown. So you see that the Italian yield change and the German yield change are more or less moving one for one. And that's what you'd expect if you did this in the US for any 2 investment-grade bonds, you'd expect to see that. So that's not surprising. But then we do the same scatter plot of Italian yield changes on German yield changes in 2011 and 2012. And now this is a regression line, not a 45-degree line. And now the relationship has flipped sign. So the surprise that is pushing German yields up is now pushing Italian yields down, and vice versa. To look at effects on currency, this is in the normal times, that is 2007 to 2010, the relationship between German yield changes and the euro-dollar exchange rate. And that is a standard positive one, as you'd expect from UIP. And that relationship still holds true in the debt crisis. So higher German yields correspond to a stronger euro relative to the dollar. But if instead of taking the German yield as the European benchmark, I take the Italian yield, in normal times it's still a positive relationship, but in 2011 and 2012, it completely flips sign. So the shock that drives the Italian yield up weakens the euro. So there's something unusual happening in the relationship between Italian yields, German yields, and the euro, particularly in the years 2011, 2012. And you see it particularly if you take the relationship between the euro-dollar exchange rate and the Italian-German spread over that period. So in those years, there are a lot of events in which you have the Italian 10-year yield going down, the German 10-year yield going up, the spread consequently going down, and the euro going up. And that's not a factor that's in the paper, but that's there at least in some events in 2011, 2012. I don't know what you call this confluence, this configuration of asset price movements. You know, if you're looking at the German 10-year yield, and I don't have the OIS rates, but I imagine it'll be the same for the OIS rates, this looks like a monetary policy tightening. Your risk-free rate has gone up, your exchange rate has appreciated. Still, I don't think that is a monetary policy tightening, because this is the thing that is preventing, you know, a classic example of this is the whatever it takes speech. Is whatever it takes to save the euro a monetary policy tightening? I would call it, if anything, a monetary policy easing, because it's bringing down the yields on peripheral bonds. If you don't like calling it that, then you can call it just a spread convergence shock. But either way, in 2011, 2012, we needed a fifth factor over and above the four in this paper, which I'll call a save the euro factor. Now, the paper doesn't find that, and I think the main reason is by construction, the factors are only loading on safe rates, on OIS rates. So you're not going to extract this factor because you're not using Italian and Spanish yields to get the factor. But in any case, even if you did a broader way of constructing the factor, it's probably only important in 2011 and 2012. So if you're talking about explaining the fraction of the share of variance over 2002, which is when they start, to 2019, it's not that big a deal. But it was there in 2011, 2012, and it is a very important factor to think of. You know, central bankers are sane and competent and cautious, maybe to a fault. So the kind of shocks we see are typically small shocks, and they are shocks of a particular variety, timing shocks, asset purchase shocks. But there was in 2011, 2012, a set of real off-the-equilibrium path shocks. And I think for understanding how the ECB works, it's important to think of those shocks as well. On this, one more point. There's a particular type of asset, which is Quanto CDS spreads. This is the Quanto CDS spread for Italy minus Germany. I thought about doing a slide trying to explain what this is, and I realized that some of you will know it, and that slide won't help you, and some of you don't know what it is, and that slide won't help you, so I didn't put that slide up. But basically, this is a clever financial measure put together by De Santis at the ECB, which is giving us the probability of a Eurozone breakup interacted with the magnitude of the devaluation of Italy's currency relative to Germany's, if that were to happen. And so this went up, and there are lines there. So I don't know what the line on the left is, but the second one is whatever it takes speech. And then the next one is the governing council meeting after that. And the next one is the governing council meeting after that. So you see that those events reduced the redenomination risk as measured by QuantOCDS. I don't think you could actually put this into the data set because it's not the kind of asset market that you've got intraday data on. But it comes back to this issue of the viability of the euro, at least during the Eurozone debt crisis. Okay, so event studies are wonderful. It's the petri dish of economics, where you get to have a little window where you know that there is one particular type of event, and that's the only thing that's driving asset prices. The downside of it, of course, is that we don't really know how persistent the effects are. And we want to think that it's telling us a counterfactual of what would happen 1 year later, but we can never really see that. So the paper tries to get at the much harder question of estimating persistence, and they get a half-life of QE shocks of 1 year. And that contrasts with more transient effects that Greenlaw and Hamilton found, and I found in an earlier paper in the US. But the point I'd say is, remember here that there are confidence intervals on all of these effects. I got a 3-month half-life for effects of purchase shocks when I did this back in 2012. But it's a very wide confidence interval. And as Eric Swanson pointed out, the results you get for the US depend a whole lot on one particular announcement, which is the March 2009 announcement. Now, that's an important announcement, and it so happens that there was a 70 basis point drop in 10-year yields that day that was completely unwound by the time of the next FOMC meeting. So, sure, it's not surprising that that effect, that makes a huge difference. I think if I were adopting a pragmatic Bayesian approach, looking at the evidence, I think that a 3-month half-life is implausibly short. And I think for the US, something like a 1-year half-life seems very, very plausible and very reasonable. The paper characterizes it as a very persistent effect of a QE shock. And maybe it is, relative to some estimates it is. But the view that at least the Fed, or the Board of Governors at the Fed, seems to have is that you measure the effects of asset purchases by the stock of 10-year Treasury equivalents in SOMA as a share of GDP. So that's a pure stock effect. So in that view, the effects of LSAPs last all the way until the balance sheet shrinks. In other words, just about permanently. So that is actually way more persistent than a 1-year half-life. This paper is great. The Euro Area Monetary Policy Database will be a benchmark for researchers. Refet, one of the authors on this paper, and Eric Swanson and Brian Sack did a counterpart of this for the US back in 2005, and it's maintained at the Fed, but unfortunately, they never put in process a method of making those updates publicly available. You know, you can get it if you know the right person to ask, but it's an unfortunate thing, and they've all left the Fed. So it's a great public service that the authors are doing here, that now this will be a repository for all researchers to work on. But they haven't just done a public service, they've also done a lot of interesting analysis on asymmetries and persistence of these effects. I can think of any number of new directions for them to go in. Of course, they can't do this in this paper. It would be a book, not a paper. But it would be interesting to see how the reactions of bank share prices to monetary policy news differ at positive rates and negative rates. There is some evidence, and Poudier and Van den Heuvel find this kind of reversal interest rate, where banks are actually hurt by easings when rates are very low. It will be interesting to see how euro area shocks affect the US. You know, the traditional view is that spillovers of monetary policy only go from the US to the rest of the world and not the other way around. But there's some tentative signs that you can also get some effects of non-US policy on the US. And there was a financial VAR using structural VARs with the high-frequency shocks as instruments. It would be very nice to have a macro version of that, so you could actually try to trace out the macroeconomic effects of these policy surprises. Thank you.
Right. Thank you very much, Jonathan. Carlo, maybe you can quickly respond to key points.
Yeah, thanks a lot. It was a very nice and good discussion. So let me just pick a few points. So of course, the last point is true. So we cannot, we hope that other people will use the data set. So we don't want to swamp the data with analysis. Although when you have all this data, many ideas comes to your mind. By the way, for example, in the paper that you cited by Skander and Miguel Ampudia, Skander van der Web and Miguel Ampudia, they use only the short-term rates to figure it out what are the impact of bank stock prices on when rates are negative. This data set would make them very easy to generalize to also other assets, not only to the short-term rates, because as you have seen before, when you enter into the non-standard measure periods, there are other measures that loads more on the medium-term and long-term segments of the yield curve that you have to take into account. So the 1 year is very persistent, half persistent. Look, remind that this is actually, so in the literature of the QE, normally you divide into the stock and flow effect. I guess this speaks a lot to the stock effect because of the announcement of the non-standard measure. So meaning that actually at the time of the announcement, the market participants react in anticipation even of the actual purchases taking place. For example, in Euro area, the largest increase in the largest decrease actually in the yields was in January 2015, 22nd of January 2015, while the actual purchases only started in March, the 6th of March. And then you have, when actually you start buying assets, you have other changes in the yields that can actually, these ones can actually make the persistence of the effect of the overall policy, I think, longer. But yeah, most of the points are well taken. So on the spreads between Italy and Germany, so as I've shown before, so in the table we have in the paper, we try to look at the QE impact, for example, for the Italian and Spanish bond, and we do see, for example, that QE narrowed the spreads. This talks a bit to what you were suggesting. Of course, this is a particular period that you're picking is 2011, 2012, it's the sovereign debt crisis. In this sovereign debt crisis, actually, the OIS is very different from German Bund. Because German Bund become actually a flight to safety, and whereby these are completely different. So there is a one-to-one mapping of German Bund and the OIS until that period, but then they diverge exactly because of that. So you have also there other information that are not typically, that we would not associate with monetary policy shock. German Bund for that period is not representative of the monetary policy stance for that period, but I agree that there are many other angles to exploit into how you can enrich this analysis, and you can look at the peculiarities of the Euro area, whereby you have these 19 countries, and well, mostly with 4 countries you cover basically 75% of the Euro area. So, and now the movement in the assets of these 4 countries might actually be guiding you to several conclusions for monetary policy action. But thanks a lot.
All right, thank you very much, Carlo. And we are a little bit short of time, but we have time for 2 quick questions. Any ideas? No? Well, let me ask, a question, like, let's say when I hear the word tick, my heart starts ticking, like slightly higher, like, And let's say working with stick data is tremendously difficult because let's say we are talking about events, intervals before, intervals after, and obviously a lot of noise is involved, you know, like, and that challenge, you know, how did you deal with this kind of problem?
So as I was saying, one of the main challenges is exactly that, you know, that you don't want to pick the wrong minutes because otherwise you are screwing up the entire exercise. That's why, for example, instead of you have an event, and normally people take 10 minutes before, 15 minutes after, and by doing that you limit yourself to a particular minute. What we did instead is to take after 15 minutes a window of time and take the median within this window so that the results are less sensitive to the quote of that particular window. So you have to adjust yourself to all these kind of particular cases to have something that automatically then split the number in a correct way, because at the end we will not, I mean, there's a code that will be running and hopefully will generate numbers that make sense. We will look into that, but we hope that is as much as automatized as possible.
All right, thank you very much, and let me announce next speaker, Michael McMahon. Well, if you believe that we have best papers on central bank communication, and if 3 papers out of 9, you know, cite Michael's, you know, works, so can we say that 33 and 3% of best papers in communication cite Michael works? And this number can increase to 40% if Michael cites himself. All right, Michael, the floor is yours.
Okay, thank you very much. And again, thanks very much to the organizers, the National Bank of Ukraine, Bank of Poland, Yuri, and everyone putting together this great conference. It's my first time in Ukraine. I had a great day when I first arrived. I gave a talk at Kiev School of Economics, and it's been a fantastic conference. You know, it's one of those conferences, as you say, it's sort of on a topic I work a lot on, and so, you know, in many ways, every paper is super interesting. They sort of fall into 3 categories, I think. At least I hope this paper will fall into one of these 3 categories for you. The papers that you've been meaning to read, and so you're just great to see them. The papers you've already read, or you've even, in some cases, discussed. And unfortunately, this paper falls into that for Jenny, who's discussing for a second time. So again, thank you, Jenny, for putting up with it again. And if Mike Ehrman is here, I feel very sorry for Mike Ehrman. This paper falls into the class of papers he probably never wants to see again. He was there when I first presented it about 18 months, 2 years ago, as a sort of work in progress, and he's seen it presented at least 4 or 5 times since then. So sorry, Mike. This is joint work with Stephen Hansen, and I know Stephen is watching the live feed, so hello, Stephen. If my phone starts buzzing, it's because what I'm saying may not concur with exactly what he would say, but I'll try and ignore it. And Matt Tang, who is at the Bank of England. Well, actually, he's on paternity leave, so I hope he's not watching. But because of him and myself, there is this usual disclaimer that the views are our own and nobody else's. Okay, motivating this is incredibly simple because it's already been done for me. There's a question: why does communication matter? Okay, that's sort of part of what we've been talking about these last 2 days. And one sort of broad distinction is this between this idea of some private information that the central bank has, which is sort of, you can trace back sort of to the Romer idea, or you can think that there's some kind of forward guidance. Like in Marco's model, this is a sort of direct signal about future decisions, and we saw other models, Jonas and Jeff's model. In fact, Jeff, in your discussion, you actually motivated the second part, which is a bit I'm going to touch on a bit more directly. There's also this finding that actually these sort of nominal monetary surprises, which you can think of at a sort of very short, relatively narrow window identified event study measures, are found to have effects, quite systematic effects, on relatively long maturity interest rates. Certainly, you know, we can all reasonably disagree about how sticky prices are, from not at all to quite sticky. I don't think anyone has in their head a sort of a price stickiness that would allow a nominal monetary shock that was a pure sort of policy shock to have a sort of 5 to 10 year impact. Okay, so there's this puzzle about why monetary policy shocks might move long maturity yields, and there's at least two. I'm picking out 2 sort of broad ones, but one idea, the Nakamura and Steinson idea, is really that the central bank provides some kind of information, so there's an information effect, but it's something that's very persistent. Okay, so it's got to be something persistent, and we'll have that exactly in our model when we get to there. The other idea that Hansen and Stein had was actually that it's actually something related to a sort of market mechanism. There are these yield-oriented investors, and short-run monetary news causes these investors to switch out of or into between short and long. Okay, and when they do this, it all turns up in the term premia, either going up or down when they switch. So this paper is essentially going to jump in at that point in the debate, ask the question. Okay, so we're going to do three things. Actually, in the presentation today, given time, I'm really going to do the first one incredibly quickly, and I'm not going to do it justice. I'll do the second, and I'll certainly do the third. Okay, so what is it? We present a model. This is not a sort of catch-all model. It's a model that was sort of written down because when presenting this paper, we kept being asked, is there any model you can write down where the type of shocks you're going to talk about can have these long effects on the economy? So the type of shocks we're going to talk about are, we're going to split between when the central bank communicates shocks about the expected level of things. You can think about these as the standard information effect channel. So we learn something about, it could be something about inflation next year or inflation 2 years from now, or it could be something about something incredibly persistent. So it could be something about the real interest rate, and if the natural real interest rate, and you think about that as a close to unit root, you can imagine that's going to have quite persistent effects. So we're going to have those. What we're going to introduce is the idea that the central bank will also give some signals, as they often do, on how certain or uncertain they are about that future evolution of the economy. Okay? And what we're going to show is, again, under certain conditions, and we can always, of course, debate those conditions, but we'll show that there are circumstances where such uncertainty communication signals can have an effect that's very small at the short end, but can kind of grow over time and have a big effect further out the yield curve, and particularly on term premia. What we're also going to show is that these expectation type shocks, it's really, at least in the model we wrote, it's really hard to generate that type of effect. At best, you essentially are signaling on a unit root, and then you get essentially a level effect. If I use Mike Weber's language, I think that's a level effect, right? So we're going to take that model, and we're going to just try and look at an environment where we can assess whether the information released by the central bank has these different effects. And what we're going to use is actually the Bank of England's inflation report. The advantage of using the Bank of England's inflation report is going to be really twofold. One, it's not going to, the Bank of England's inflation report in our sample is released at a separate time to the monetary policy decision. So we're not going to conflate the policy decision. We're going to have, after the policy decision, a week later, they're going to release the information and the forecast that were sort of used as the underlying analysis for that decision. Okay? That's one advantage. The second advantage of this is it's a source of information that has both quantitative forecast information, so explicit numbers on lots of elements of the forecast, as well as a rich source of text. And it's that sort of lots of information on the numbers and lots of words that's going to allow us to say something, because we're going to use the multidimensionality of the words to really ask the question, are the shocks that move the short end of the yield curve the same shocks that move the long end? That's almost necessary for both Hansen and Stein's story and the Nakamura-Steinson story, not for our story. Okay? What we're going to show is that actually we find different sources of information. It's not coming up on, oh yeah, there it is. Don't look at your own iPad because the clicker doesn't move your iPad. That's something I've learned. That's what it is. Okay, what we're going to find is we are going to find, in fact, that this uncertainty channel, at least in our environment of the Bank of England's inflation report, seems to be having quite a bit of effect. So this is essentially what we're going to be looking at. You know, the news that's released, this is a copy of the FT from the day of the inflation report, pound and gilts await Bank of England view on inflation. Okay. Most people in this room, again, the joy of having such a focused conference, I think most people know what the Bank of England's inflation report is. As I said, key things, released after the policy announcement until 2015, so our sample is going to end in 2015, because after that the sort of release schedule changed. Contains numerical forecasts for output and inflation. The fan charts are the sort of famous visual aspect of that, but you can, on the day it's released, you can get the full numerical distribution skewness, etc. of these things. And as I said, a rich source of text. Importantly, it is not a document for forward guidance. Okay? So there's not any explicit statements about future policy, but of course, you know what decision they made, and you now know what forecast they made. Maybe from that you can back out something about what the sort of implied policy view was, but there's nothing explicit in this document. Okay, so again, set up by the last paper, event study, slightly different event study in the sense that the interest rate happens back here, and we're going to look at this day here, where on this day we release the quantitative information and all the words in the inflation report. Okay, so here's just a slide. I won't spend too long on it, but again, to the uninitiated, and this sort of picks up on Wouter's comments yesterday, to the uninitiated, you might be pretty disappointed that these numbers, this is the kernel densities of moves, absolute values of the yields at the 1-year spot, the 3-year forward, the 5-year forward, and the 5-year forward rate. These numbers might look pretty small, right? But actually, in about half the cases, you get a move in the 3-year forward rate that's 5 basis points or more. The surprises on these days tend to be quite small, so these are actually quite big shocks, and in a fifth of the time it's greater than 10, and then there's a few sort of really big news events. Well, I'm going to talk about the model, but I have to sort of be very upfront and honest about something here. Once you start thinking about this in a sort of more complex way, you'll realize that, you know, this, even just working out what the signal sent to markets is a very high dimensional and complex thing, right? You would need to know all the prior beliefs about everything that was in there. You'd need to know exactly everything that's in the information release, which we have, and somehow combine these things in a way to get the signal, which would then lead the market participants to update their beliefs and then lead to the market news. In our model, which I'm not going to go through fully, but just to, if anyone digs into it and gets disappointed, we're essentially going to jump in at this point here. We're not going to say what signals exactly cause the updated beliefs. We're just going to send signals that lead to updated beliefs. So in reality, and this is going to come back when I talk about the empirics of this, in reality, mapping a particular signal to a particular market move the exact mapping is not necessarily easy to interpret. Although actually, I'm going to be quite happy that the signals that seem to move the rates are interpretable. I just forewarn you, I don't think it would always be the case, but we'll see. The model is very, very simple. There's a monetary policy rule where rates react to the state of the economy, and there are shocks to that rule. Economic conditions, we model them just as a simple AR1, but with two components to the uncertainty shock that hits. One is something that the central bank essentially can forecast. So mu m you can think of as something the central bank forecasts, and the central bank will release its signals about what this is and what it's going to be over the forecast horizon. The other part is some sort of fundamental uncertainty in the economy, and this we assume evolves according to a stochastic process, and the central bank is also going to send some signals on that. Now in the paper we make a very stark assumption that the central bank is going to get a perfect signal of that and they're going to release it. If you wanted to build in extra layers of uncertainty to that, you could. I don't think it's going to change the interpretation. I'm going to skip the rest of the model, but just tell you the two key propositions. The first is, and I can sort of summarize this nice and easily, if they send signals on the state of the economy, so actually I'll go back. If they send signals on this mu m, the effect of that is going to fade over time according to rho. So again, you can think about this as a vector of objects, so some of them being highly persistent, some not so persistent. The more persistent things you might think of as like the real interest rate, and the market moves might be considered highly transitory. But the best you can do essentially is, if this is 1, that you would send a signal on something that's permanent and then you get this levels effect. But getting something that builds over time from an expectational type signal is difficult. On the other hand, so long as this is sufficiently large, if I send you signals on uncertainty, the bands of around my expectations can grow over time, and essentially you can, again, for certain parameters, and we don't estimate this model, but we just want to show that there is a situation where signals on uncertainty could generate these sort of growing effects, Moreover, they would turn up in term premia. Okay, so two sort of quick things. We assume that in the model, the signals are sent just in the forecast horizon. It's of course possible that you send signals further out. So every statement I make about you send it at the end of the forecast horizon. If they made it further out, you start the analysis there and it fades away if it's an expectational shock, or you start the analysis there and it can grow if it's an uncertainty shock. But what we really want to do is use that idea to distinguish between the different channels. So in the model, we have the Nakamura-Steinson type expectations channel, the traditional information effect channel, which we think, there should be this effect on expectations of future rates, but not necessarily going to be able to grow over time, or won't be able to grow over time. Our uncertainty channel, which will arise mainly through the term premia, and then the Hansen-Stein channel, which isn't in our model, but the Hansen-Stein channel would be short-run monetary news leading to movements in longer-term term premia. But it's the same information that moves the short-end expectations that should move the longer-term premia. And what we do in the paper, now it's not an iPad problem there, we're going to use the narrative data from the inflation report to test it. Okay, so the following are the steps. One, well, we're going to use the words in a way, but words are clearly endogenous. So we're going to do, the first step is going to be to purge the asset price news of the numerical forecast. This is often people assume that words matter because you can extract from them an underlying forecast. This is an environment in which we have the actual forecast and the words around it. So we're basically going to purge the asset news and the words of the effect of the forecast, numerical forecast parameters, in a sense creating asset price residuals and narrative shocks in a kind of traditional Romer style purged, but applied to text. Then we're going to ask, do the narrative shocks contain information for the residual asset price news? The answer is going to be yes, and I'll show you some results on that. And then we're going to ask the question, is it the same information that moves the short end as moves the long end? And just so as a preemptive strike on the results, the answer is going to be no, it's most of the long end news is generated by different signals that move the short end. Okay? Now there's an open question, and that is whether or not we want to examine the effect on the absolute value, which is traditional in lots of the communication literature, to look at news, or to look at the actual change in the yield, which will give us some sense of direction. Now, this is a really sad reflection of how long it's taken me to react to Jenny's first discussion. She raised this issue in the first discussion. We had originally done it on the directional stuff. Then we moved to news. And the version of the paper she's commenting on only has the news. But I've been talking to her in the last week, back and forth, and I have told her I will show some results. You can do it with directions as well. And I think the same thing all goes through. So what do we have? We have 15 quantitative variables that we get from the Excel spreadsheet of the Bank of England's forecast. Some of them are obvious ones, like the 2-year ahead forecast horizon numbers for GDP growth and CPI. We also have the variance and skews of those. We also look at the differences of those from the market's expectations, which we have from other surveys. We look at we don't have market guesses for variance and skew, so we look at the difference from the previous IR. And we have backed out implied output gaps, okay? And then in terms of the text, we have 15,000 paragraphs, 1.3 million words, and what we're going to do is we're going to break it down. For looking at the news, we're just going to look at what they're talking about. So we're going to reduce that using something we've used before, the latent Dirichlet allocation, into essentially a 30 topic model, which then, because we look at both the levels and the changes in what they talk about, because it's not obvious which one matters, we're going to have a 60-dimensional object that summarizes our text. So for example, I'll show you, here's some of the LDA output. It estimates a topic that's clearly, well, we think is clearly about the labor market, unemployment, jobs, employment, hours, people, participation. And then it tells us how much they talk about it in the inflation report. So there are some periods where it goes up a bit, sometimes it's lower, and sometimes it's up again. So we look at both the level and the change in that as possible drivers of the narrative news, okay? Let me move quickly because I realize it always takes me longer to get to this point. Here's just the first stage sort of regression of, this is the absolute value in the 1-year spot, the 3-year forward, 5-year forward, and the 5-year forward. And the first column in each set includes just what we might think of as expectational variables. So inflation forecasts, surprise, the absolute value of the surprise on inflation, growth, output gap stuff, and then the second column adds the news from the distributional information. Now, it's not a formal check on our model, but we used to just include these in one column because we sort of treating them as a sort of noise. But actually, if you look at this, you do see that the amount of the sort of explanatory power, two things stand out. One, at the short end, we can explain far more of the news with the forecast variable. That's, I think, kind of to be explained. This is a 2-year ahead forecast. This is a 3-year forward rate. You'd imagine over time it falls, it does. But the amount of that variation that's picked up from the distributional information rather than the expectational information grows over time. Okay. So I'm not going to say any more of that. You can now think we've purged the market news of the effect of that numerical information. We also purge all the topic text information of those same variables. And then we're still left with a problem. Because we only have data for 70 inflation reports, we have this 60-dimensional object where we've already purged out 15 variables, right? So we move to this elastic net regression. If you know lasso, that's a sort of variant of it. This is just stuff that's used a lot in high-dimensional statistical analyses or big data type stuff. Of course, we're not even close to big data with 70 observations and I think it was 75 possible regressors, but it's still useful. This is the penalty function, and that's going to essentially punish the inclusion of variables that don't contain enough information. Okay, so we run it. What do we find? We find that the lasso wants to include lots of, in fact, the maximum possible number of regressors. That itself is not a test, but we design a sort of permutation test. I won't go through it, but essentially with 500 randomized draws of these combinations, you never get those numbers. Okay, so this is, we think, very sort of strong evidence that at least there's some information, statistically significant information within the narrative news. More interesting is to then use an approach which we develop here you can essentially rank topics. Don't worry about the exact labels, but we can rank them according to which one is sort of considered most important for explaining that horizon of the yield curve. We do that. You can look at what they are. So at the short end, the topics are things, the level related to things falling, sharply fallen, etc., sharp, large. I'm guessing this was something around the crisis especially. Some market data, something about demand side, something about the demand and recovery period. The long end is much more about other things. This relates to the inflation forecast fan chart. We have information on risk and uncertainty. This is to do with the inflation target. The sample ends in 2015. This has nothing to do with Brexit. This is just their discussion of the forecast. Okay, so that's what drives it. You can then ask slightly more formally, if we take those 60 objects which have now been ranked by importance, is the ranking the same across the different maturities? And the answer is, what drives the short end is uncorrelated in terms of ranking with what drives the further out, but then further out particularly you have some correlation between the top topics. You can sort of look more in detail about how much they explain. You can see, if you just use the numerical, you explain about 56% of the variation at the short end. If you add the top 4 topics, you get up to nearly 70. Okay? If instead we go to the longer end, the numerical stuff only explains about 27%, and you basically double that by adding just 4 topics. So 4 topics at the long end about risk and these things explain as much as 15 numerical variables. Again, you can do this split by term premia versus expectation, but I have to jump on because I'm about to get my warning sign. This is, I think, the most interesting part. What you can do is you can do placebo tests. So you can ask, well, if I take the top narrative shocks that drive the short end, do they significantly explain any variation, residual variation, in different assets? So this is what you would have seen in the other table. This is a partial R squared. You can do it with other measures. This says that if you use the narrative shocks from the short end and try to see if they explain anything significant at the long end, the answer is no. If you take the shocks that move the long end, and very significantly move the long end, do they move anything else? Yes, well, what moves the 5-year forward also moves the 5-year forward. That probably isn't so surprising, but what's amazing is it really explains nothing at the short end. Just adds no information. Again, and you can do this now, you can do the same placebo, but you can look at it by the shocks that move the term premia. Do they move anything? And you do see that actually what really moves the long end is the term premia. It's the term premia topics that move the overall rate. Okay. I wanted to, actually, Mike Weber, you set this up because I wanted to show some results on direction. For direction, the problem is that LDA has no directional interpretation. If I talk about inflation, I can say it's going up, I can say it's going down. I'm still talking about inflation. That's what LDA would pick up. So in order to try and look at the directional changes, we do a very simple, as Mike did earlier, this sort of balanced measure on the basis of word lists. We'd used it before in an old JIE paper. The words actually come from an old Riksbank paper. We repeat the entire exercise. I'll just show you some things. Again, using direction, it's different information that drives the short end than the long end. There's a little bit more correlation now. So things that move the short end directionally do a little bit to the 3-year forward, but again, the main results are strong correlation at the longer end. If you look at the placebo, again, there's no effect of what moves the long end moving the short end and what moves the short end moving the long end. And again, it's a little bit more mixed up here, but I can talk about that later if people want. So that's all I wanted to say. Like I said, I think this question, this open question of what drives the effect of communication that we find repeatedly on markets, and we sort of in this paper trying to argue for a bit more attention on the effect of communication about uncertainty as potentially being important. But I shall stop there.
All right. Thank you very much, Mike. Fascinating talk. And now, Jenny, please.
Okay, so I'd like to also thank the organizers for giving me the opportunity to discuss this paper a second time. Even though it was a second time, I think reading the paper again really allowed me to dig deeper into it and think more about the big picture and the nuances in the paper, so it was quite interesting. And of course, the usual disclaimer applies. The views expressed in this discussion are my own. This is not a piece of official central bank communication. So let's just get into it. So the main question in this paper is through which channels do long-term interest rates respond to central bank communication? Right, and just some motivation for this question, of course there's been a recent push towards more and more central bank transparency, and our experience at the effective zero lower bound has really brought central bank communication to the forefront. At the same time, the transmission of communication to long-term interest rates is probably more important at the effective lower bound as well, because all you can really do is move the longer end of the yield curve. And there's an ongoing debate around whether this transmission is through expected future short rates or through term premia, which parallels a similar debate that's going on in the literature on the effects of quantitative easing. And really, this is quite an important debate. Even though this paper is focusing on the effects on just long-term interest rates, once you step outside of that, expectations about future short rates and term premia can have very different effects working through the rest of the real economy, even if they essentially both move long-term interest rates in the same way. Okay, so just a broad overview of what the debate is. So there are some papers out there that say that transmission works through expected future interest rates. I think Michael already highlighted some of these. So Nakamura and Steinson talk about this information effect. There's a paper by Carvalho and co-authors that construct communication surprises in FOMC statements on just the hawkish versus dovish scale. They also find that it's mostly working through expected future real short rates. On the other side, you have evidence that there's transmission working through term premia. So, of course, Hansen and Stein, as Michael reviewed, finds that FOMC announcements affect term premia through what they propose is a reach for yield behavior of investors. There's a paper by Bundick and co-authors who find that they look at uncertainty surprises around FOMC announcements, which they kind of loosely relate to FOMC communication, and they find that those move term premia as well. Stepping a little bit outside of the bond space, just in general, thinking about risk premia, there's also evidence that central bank communications affect risk premia. And in fact, I have some work with a co-author looking at exchange rates and basically currency risk premia, and finding that during the global recession, essentially the information channel through countercyclical risk aversion can move term premia as well. So the information channel can actually show up in both components. All right, so I should say here too, just going back up one slide, is that you might think that the view held by many before the crisis is that you use forward guidance to move expectations about future short rates, and you use QE to move term premia. But I think what's really nice about this paper and bringing to light that communication can affect term premia is it gives you another tool with which you can move term premia. And if a central bank wants to move term premia, that can be very useful because it comes with a different set of trade-offs. There might be fewer political costs of using communication instead of expanding your balance sheet and looking like you're bailing out the financial sector, right? Okay, so some of the advantages of this paper beyond what's currently in the literature is I really like how they're measuring communication in a more nuanced way, right? So a lot of previous papers measured communication really vaguely through extracting these factors from asset price reactions, right? They use that to talk about communication, which is a great first step. But I like that the communication here, it's not requiring a particular asset price response. So you can capture a lot more dimensions of communication. Similarly, it's not measured in a way that's defined, like predefined in terms of, for example, a hawkish, dovish scale. It's really allowing a lot of other dimensions, really allowing the text itself to speak. And also they are able to isolate communication from policy action by looking at these inflation reports that are published at least a week after the policy meeting. So I think these are all nice advantages of this paper. I'm not going to go through this slide, which just summarizes the methodology and some key results, because I think Michael did a great job on that. I'm just going to go straight into my comments. So first I want to talk about, look more deeply at the transmission of these expectations and term premia and narrative signals that they have in the paper. In particular, I was curious as to whether these term premia signals capture elements of term premia other than uncertainty. Then I'll talk a little bit about some data issues I think that still remain. Okay, so again, just reviewing a little bit what these expectations and term premia signals are. I realized as I was watching Michael's presentation that I essentially created the same exact table that he had in one of his slides, but I think he, because of lack of time, went through it a little bit quickly. So I get a chance to go through it a little bit more now, which is that, so they basically find these narrative signals that best explain not just the overall change in the, absolute change in the yields at different maturities, but also the component of the yields changes that are due to the expectations part of yields and separately the term premia part of yields. And you see that for the short end, so the 1-year yield, the signals extracted for expectations basically explain just as much variation as the signals that best explain the overall variation. Whereas the term premia signals aren't significant and have a much lower R-squared. On the other side, at the very long end, it's really the term premia signals that are doing all the heavy lifting. And these term premia signals don't really explain anything of the short end. And one thing I want to point out here, which I find interesting, is that the lack of explanatory power of these term premium signals for one-year rates really suggests that it's capturing a different dimension of communication than previous work, which relies on extracting factors from like changes in futures prices up to just 1 year ahead, right? So they're really getting something else here. Maybe it's a little bit closer. So there are papers, for example, Swanson 2018, that he extracts an LSAT factor, and this is based on using up to a 10-year yield to do the principal component analysis. So maybe it's a little bit closer to something like that. But most of the previous papers in this literature don't look that far out. So they probably don't have something that's like this term premium signal. So I'm going to do a bunch of regression exercises now, since Michael so graciously agreed to share his data with me. What I'm going to do is actually to focus on their expectations and term premium signals. They extract a separate set of these signals for each of the 4 maturities. I'm just going to take, for both expectations and term premium, the ones that show up in at least 2 of the maturities. So that there's one set of expectations and one set of term premium signals. So the first question I want to ask, just really straightforward, is are these expectation signals capturing expectations? And to do that, I simply regress. So I took basically the same exact methodology they had, but regressing absolute changes in different variables on the controls and the signals. So the thing I did to capture expectations is to ask whether these signals have predictive power for the absolute change in the actual short-term interest rate at various horizons. And the different columns here are just different regressions where I sort of successively add in different sets of variables. So it starts with only the VIX, then it adds in the quantitative expectations variables, then the quantitative uncertainty variables, and then to that set of all the quantitative variables, I add either the expectation signals or the term premium signals. And I also produce the same statistics, which are the partial R squared and the F-test of joint significance of the set of new variables that I'm adding to each specification. So the red box shows you that indeed these expectation signals do significantly predict longer horizon interest rate changes. So that's nice, but then you can try to ask, okay, well, what aspects of short rate expectations is being captured? What economic aspects of them? And so to do that, I use data on the mean consensus forecast. So these are professional forecasts on a variety of economic variables. And for this, I'm looking at, it's a monthly survey, so I look at the absolute 1 month change in these forecasts. And what's actually nice about this, and totally by coincidence, is that there's often a publication of a forecast just 2 days before the inflation report is released. So the timing lines up pretty well here. And what you see is, so surely it's moving the consensus forecast for the short-term interest rate at both the 3-month and 12-month horizons. In terms of the economic variables, there's not a whole lot of action. There's a little bit of action in the 1 year ahead inflation forecast, so maybe that's what's being captured in terms of the expectations here, which makes sense. It's an inflation report after all. So that's kind of reassuring as well. So next we can look at the term premium signals. Is there direct evidence that they're capturing uncertainty outside of just looking at bond term premium? So here I'm regressing again the absolute changes at various horizons for the daily economic policy uncertainty index that I downloaded from policyuncertainty.com. This is the Baker, Bloom, and Davis kind of measure. And here you do see that at least the kind of 1 day, so the day of the announcement and 1 week ahead horizons, the term premium signals do have predictive power for economic policy uncertainty. You see that the term premium signals also predict the sample standard deviation of 1 day changes in short-term interest rates going out to about like 2 years ahead. So this is just like kind of a realized volatility that it's able to predict, so that's nice. And again, here you can ask the same question, well, kind of uncertainty are the term premium signals related to. And so for this, I again turn to the consensus economics professional forecasts, and here I'm just looking at, so there I don't really have like a good subjective uncertainty measure. What I do have is forecast dispersion, which I realize is a little bit different, but it's what I had. So there I look at the absolute 1 month change in forecast dispersion measured by the interquartile range. And yes, I find something on the 3 month ahead forecast of the short-term interest rate, but I'm really not seeing any action in the economic variables, including in inflation. And I should say also I tried the unemployment rate, and that looks very similar to GDP. So really maybe this uncertainty that is being captured, which you saw in the previous 2 slides, is some sort of more vague uncertainty about maybe either policy preferences or targets rather than about the economic fundamentals per se. And lastly, I found some evidence that term premia signals actually correlate with some longer term expectations. So the consensus survey twice a year surveys their professional forecasters to give longer term forecasts. So these are absolute 6 month changes, and the timing doesn't line up quite as well, but I was actually trying to use this regression to say something about the expectation signals capturing maybe longer term expectations, but what I saw instead was that it was the term premium signals that ended up having a lot of predictive power. Is this a problem for their interpretation? Maybe, because if you look now, I've so far ignored the columns with the quantitative variables, even though there is some interesting stuff there just in the interest of time. But here I do want to point out that the uncertainty quantitative variables also seem to be moving these long-run forecasts. So there might be some relationships there, not surprisingly, between uncertainty and the real economy and expectations that's going on in the background too. Okay, just to end with what my empirical concerns are and some extensions that I think would be interesting. So this slide is mainly concerns, the next slide is extensions. So one thing is I wonder if there's a better way to construct these narrative surprises. So what they've done is purge these narrative signals of variation correlated with the numerical variables in the same inflation report, which of course that's very important and it's great that they've done that. But in this kind of event study analysis, what the asset prices are responding to in this 1 day window is really, it should be the surprising part of the report, right? So there is some sense in which market participants were expecting them to say certain things and maybe they've deviated from those expectations. So my question is, what about investors' expectations for the text? Shouldn't we also clean out variation correlated with narrative signals, maybe from the preceding inflation report, so their difference measure kind of gets at this, but maybe even narrative signals from the minutes from the same meeting that were released a week ago, or media reports in anticipation of this inflation report release to try to get at what markets were expecting for the text itself. Another issue is in this like event study setup is that there are actually other events that occur on the same day. And it was a surprise to me, but 50 out of these 70 inflation report releases in their sample overlap with the release of the UK labor market report, and this report often came out just an hour before the inflation report. So I'm just wondering if this kind of concurrent important event would create problems for the analysis. In terms of extensions, I think there could be some interesting interactions there between the narrative signals and numerical information. So I have some work looking at central bank FOMC communications, which kind of suggests that what the FOMC talks about in their communications can direct market attention to different types of news. So in this context, it's possible that the text of the inflation report itself kind of directs attention towards maybe the inflation forecast or the GDP forecast in a particular report. So there might be some interactive effects there. And I think there could be a lot more done with the text. It's such a rich data set to measure, again, this question of what kind of uncertainty these signals are reflecting, or what kind of expectations about what kind of macro variables. Okay, so lastly, policy implications. I think, Michael mentioned we talked about this before. I think it's super interesting that this paper finds that narrative information does matter, but to make things really operational for a central banker to be able to say, well, if we change the communication in this way, long-term interest rates will go up or down, you need to push the next step of the analysis towards getting the level effects. And then, again, I think something that came to mind when I was reading this paper was that this paper shows that words matter, but should they matter? Is this just showing that the quantitative variables aren't having enough explanatory power? Should they be improved? Instead of having people kind of rely on the text and subjectively interpret the text. Okay, so in conclusion, I found this to be an extremely interesting and thought-provoking paper. I think they're contributing very novel data and techniques to this debate. And I think it opens up a lot of exciting avenues for future research and more ways to tailor central bank communications towards policy goals.
Right, thank you very much, Jenny. Maybe 1-2 minutes quick response.
Okay. Thank you again, Jenny. Another great discussion, and the benefit of sharing data is you get incredibly great new ideas on things to explore. So definitely to look at those a bit more. And I certainly agree with your conclusion that there's a lot more that can be done. So I look forward to us doing that and others doing it, and etc. I will mention a few little things. One is I have a student actually at the moment who's done a little bit in the direction of what you're doing, but looking at precisely at these sort of information and how they move option price distributions. So a student at Oxford, Tim Monday, and he's sort of I haven't cited it yet because it's technically still an exam because it hasn't been marked yet, but his master's dissertation is very supportive of this. At least it's sort of 2-year horizon on the distribution. So there is some more stuff that we can do, and some of the stuff you did was fantastic. I think you absolutely hit the nail on the head. I mean, one of the hardest things, the big challenges in this communication literature, if you go from the market approach, you can look at exactly the market expectations in a narrow window, and that's a nice way to purge out expectations. But then it's really hard to know what dimensions we're moving it. If you I sort of think of that as the Rafet GSS type approach. What Stephen and I and many others, of course, have been doing is coming out from let's measure the communication and try and get to the same thing. There, the difficulty is what is the expectation? It's really hard to get an expected inflation report. Central banks spend a lot of time writing them, but markets may spend a lot of time reading them. They don't prepare their own prediction of what it will be. And so we've tried different things in different papers. So in some we run them through VARs, in this one we just use this sort of exact data that's regressed. I think there's more we can do. One difficulty we face with the Bank of England is Bank of England's statements, which are released a week earlier, don't, apologies Emma if you're still listening, and everyone else from the Bank of England, they don't contain much information. They're not as detailed as the current sort of Fed style release. It really says, we did this. And that's it. So the minutes only come out after the inflation report. So again, it's a little bit tricky. But I think we can try more media reports. We've been sort of working on a little bit. And then finally, just to say, two things. I think the non-linearities could be really interesting and important. Should words matter? I think that's a great question. I really do. At one point we got into this really to ask whether the words did matter at all, because at some point people do a lot of research on the Fed, and the Fed doesn't release these numerical forecasts. So maybe the words just matter because we're extrapolating, as you say, their forecasts. And then at the other end of the spectrum, you have the Norwegians, and they release everything. So maybe there's some cross-country thing that we can do. But yeah, types of uncertainty. Actually, we're working on that. We'll watch this space. But no, thanks. Great discussion again. Thank you.
Right. Thank you very much, Michael. Do we have questions? 2. Perfect. Exactly 2.
Hi, thanks for the discussion. I'm Ishta from the Central Bank of Uganda. I want to comment on this question, should words matter? like it just blew my mind a bit that because for the last, I don't know how many months, we've been editing our State of the Economy reports and our monetary policy statements to have more words, more explanation, more reasons beyond, we did this, here are the numbers, here's inflation, here's NPLs, here's, if actually for editing our monetary policy statement, one of the things we've been trying to do is, if these figures, if this data is available somewhere else, we don't want to repeat it in the report. We want the report to be contributing something that, not just our forward guidance, but also in terms of like, explain accounting for our actions, So, yes, words matter. Words have to matter, should matter. There's a paper, I'm sure some of you have read, Narrative Economics by Schiller, where part of the role of an economic policymaker is actually to tell a story. The idea that words kind of, the weight that they have is something I think we can't ignore and we can't run away from. I'm not asking a question, I'm just making a comment. Yeah, thank you.
That's okay, I did that yesterday, so it's perfectly acceptable. Fully endorse. Comments, rants, anger, joy, whatever you have, bring it on.
Hi, Eric Walczak, Bank of England. I have a quick question about text analysis. So you mentioned using LDA here. Have you considered using pre-trained models like GLOF or BERT? Because they tend to perform pretty well in clustering, and they could potentially improve some of your models.
Yeah, that's great. So yeah, there's the advantage of LDA is it's an unsupervised learning model, but so not for this paper, but for some other work that's ongoing, we are exactly using, I think, more state-of-the-art from data science rather than from economics methods to try and get a better grip on what we have. So I'll be very honest here. The big difficulty with LDA. So really the interesting thing you want to know is, are they talking about the economy or are they talking about their reaction function? And there's really nothing that constrains LDA to give you those sort of topics. So in fact, Stephen and I in our JIE paper, we had LDA and it picked out a bunch of nice economics topics, but there was none that looked like forward guidance. So what we ended up doing in that paper is we took what Jonas and Jeff and others had done with this was for the Fed, with defining the paragraphs of forward guidance, and we used those and scored them as a forward guidance score. So that was that was called manual text analysis, but they did all the work, so that was fine. We're now doing some stuff where we are using learning models, so we actually can tell it this is a forward guidance statement, and it can learn this is what a forward guidance statement looks at, and that allows you to get you can sort of scale it up a lot more. So we're doing it, the results are very promising, but that's another day. Yeah.
All right, and the very last question.
So when I learned Lasso, I learned that it was a very dangerous tool to bring to a central bank, because you're never supposed to look at the coefficients. You're supposed to look at the fitted values, because the coefficients can be very unstable across different samples. There's lots of ways of getting a good predicted value given the number of regressors you have. Yeah. And so I'll phrase it as a question. Do I need to report you to the Lasso police for looking excessively at the coefficients, or can we interpret some of the stuff you did at the very end as really talking about the fitted values?
Okay, so I didn't know there was a Lasso police, but I'm an academic. There's nothing that says you can't bring Lasso to an academic institution. It's different in central banks. No, you're right. There's a bunch of things. I didn't have time to talk about them today. You have to be very careful when you use Lasso. That's absolutely right. So technically, we're not using quite Lasso. We're using a sort of step away from it to allow for more correlated regressors, which is one of the issues that comes up with Lasso. So there's a bunch of steps in the paper to try and do it as right as you can. But equally, we don't actually interpret the coefficients, even though after we've done the Lasso, we never look at the coefficients of the Lasso. We use that to tell us which ones are sort of, the Lasso thinks are most informative, and then we put them back into OLS, okay? But even then, in the OLS, we look at measures of fitted value, essentially, rather than exact coefficients. So it's a selection operator. That's what the so is. We use it as a selection operator. Yeah. But yeah.
All right. I would like to thank speakers, discussant for excellent session. Thank you very much.